Powell, wanted to turn to you on that question. On days like today, you hear people louder talk about stretched valuations and euphoric sentiment and positioning, everybody being on one side of the trade. How would you assess those factors right now, and what does it mean for the coming action?
Sure. Yeah, well, first thing I would ask, are they talking about the fixed income market or the equity market, Sarah? And Happy New Year, by the way. So we're coming off 2020. 2020 went down as the second most volatile year since 1930, other than 2008. Lots of noise in the market. What we would say is we like the market for three different reasons. First, the technical story. We do not expect a repeat of volatility from last year. If volatility were to normalize based on really strong guidance from policymakers, that's a positive sign for taking any risk, whether it be credit or equities. The second thing is fundamentals. We are looking at a consumer that is just fine. Actually, pretty good because of how low interest rates are, that are going to be unleashed in pent-up demand, we think, in 2021. And the third thing, to your point, Sarah, are valuations. And the valuations right now, if you look at the S&P 500 trading at 21 times earnings and looking at a 10-year treasury that's trading below 1%, it's the 10-year treasury that's expensive, not the S&P 500. And forget about cash. If you want to sit in cash and just bleed negative carry every day, that's really the expensive trade. So we would say on a valuation perspective, valuations are just fine as long as rates stay this low and you have a really, really supportive policy backdrop with fiscal and monetary policy, Sarah, being double of what it was in 2008 at a time when the consumer's just fine. I mean, this is a really, really good environment for taking risk, in our opinion, in both equities and credit. It's not just an equity story, Sarah.
Shepard Smith here. Thanks for watching CNBC on YouTube.